Welcome to our video, where we delve into the captivating world of Tulip Mania, a speculative frenzy in the Netherlands during the 17th century. This intriguing episode in the history of economics offers us invaluable insights into the hazards of financial speculation and the significance of rational decision-making. The Tulip Mania resembles recent phenomena like the NFT boom or the East India Company's monopoly. Both instances witnessed significant price surges and speculation, resulting in drastic market corrections. Examining these events and comparing them to Tulip Mania enables us to comprehend the potential dangers of unfettered speculation and the need for caution when making financial decisions. Tulips have been cultivated in various parts of the world for centuries, but became prevalent in the Netherlands in the 16th century. The Dutch climate and soil were ideal for growing tulips, and the flowers quickly became a status symbol among the wealthy. Tulip bulbs were first introduced to the Netherlands in the late 16th century by Carolus Clusius, a botanist appointed as the director of the Hortus Botanicus in Leiden. Clusius was fascinated by the exotic flowers and had a garden where he studied and cultivated them. Clusius's work quickly attracted the attention of wealthy merchants who began to import tulip bulbs from Turkey and other parts of the Ottoman Empire. The merchants soon realized a high demand for flowers among the Dutch elite, and they began to sell the bulbs at a premium. By the early 17th century, tulips had become a status symbol among the Dutch upper classes, and people were willing to pay large sums of money for rare and exotic varieties. The most sought after tulips were those with unusual colors or patterns, such as the Semper Augustus, which had a white background with red flames. The Dutch soon became skilled at cultivating tulips and developed new varieties by crossbreeding different strains. This led to an increase in the supply of tulips, which fueled even greater demand. By the 1630s, tulips had become a significant industry in the Netherlands, with many people making their living by growing, trading, or selling flowers. However, the high prices of tulips meant they were still luxury items that only the wealthy could afford. Chapter 2. The speculative bubble known as Tulip Mania began in the early 17th century as traders and investors started buying tulip bulbs to sell for a profit. The tulip market quickly became a frenzy, with prices rising rapidly as demand increased. One of the critical factors that contributed to the rise of tulip mania was the emergence of futures trading. Futures contracts allowed investors to buy and sell tulip bulbs before they were harvested, increasing speculation and further fueling demand. As the tulip market heated up, prices began to skyrocket, with some rare bulbs selling for the price of a house. Tulip traders became celebrities, and many people began to see tulips as a surefire way to make a quick fortune. The tulip market was driven by hype and speculation, with buyers often purchasing bulbs simply because they believed that they would be able to sell them for an even higher price later on. The market was largely unregulated, and many buyers and sellers were operating on credit, which meant they were taking on significant financial risk. The market speculation became increasingly detached from the reality of the underlying product. Buyers were no longer interested in the flowers, but in the potential profits they could make from trading tulip bulbs. This detachment from reality led to tulip bulbs being valued far above their intrinsic worth. In the winter of 1636-1637, the tulip market peaked. Prices for tulip bulbs had risen to extraordinary levels, with some bulbs selling for the equivalent of a small fortune. Many investors had become extremely wealthy from trading tulip bulbs, and the market symbolized Dutch prosperity and economic success. However, the tulip market was built on speculation and hype and was unsustainable in the long run. The market was highly susceptible to rumors and speculation, and any news that suggested that the market was faltering could trigger panic among investors. In February 1637, a rumor began circulating that the government planned to intervene in the tulip market and regulate prices. This news caused panic among investors, who began to sell their tulip bulbs in a frenzy. The market collapsed almost overnight, leaving many people with worthless bulbs they had purchased at inflated prices. The collapse of the tulip market profoundly impacted the Dutch economy and society. Many people who had invested heavily in tulip bulbs lost their life savings, and the economy went into recession. The Dutch government was forced to step in and intervene in the market to prevent further economic damage. Despite the economic fallout, the Tulip Mania episode did have some positive consequences. It led to a greater awareness of the risks of financial speculation and the importance of rational decision-making in investment. It also contributed to developing financial markets in the Netherlands, as investors and traders sought new opportunities to invest their money. Economists and financial historians have long studied Tulip Mania as a prime example of the dangers of speculative bubbles. The episode provides essential lessons for investors and traders alike and has influenced our understanding of financial markets in many ways. One of the critical lessons from Tulip Mania is the importance of rational decision-making in investment. During the tulip bubble, many investors were driven by irrational exuberance and greed, leading to a frenzy of buying and selling that was divorced from reality. By contrast, successful investors today take a more rational investment approach based on sound analysis and research. Another lesson from Tulip Mania is the importance of diversification in investment. During the bubble, many investors put all their money into tulip bulbs, ignoring other potential investment opportunities. This lack of diversification left them highly vulnerable to the collapse of the tulip market. By diversifying their investments across different asset classes and industries, investors can reduce their risk and potentially earn greater returns over the long term. Tulip Mania also highlights the importance of market regulation and oversight. The market was largely unregulated, which allowed speculation and hype to drive prices to unsustainable levels. Today, financial markets are heavily regulated, with governments and regulators playing a pivotal role in ensuring that markets are fair and transparent for all participants. Finally, Tulip Mania underscores the importance of historical perspective in understanding financial markets. While the tulip bubble may seem like a bizarre and isolated event, it is just one of many speculative bubbles that have occurred throughout history. By studying these past episodes, investors can better understand the patterns and trends that drive financial markets and make more informed decisions. Tulip Mania was a fascinating episode in the history of economics, showcasing the power of speculation and the dangers of irrational decision-making in investment. While the bubble ultimately collapsed, it left a lasting impact on financial markets, influencing our understanding of investment strategies and the importance of market regulation and oversight. Today, investors can learn from the lessons of Tulip Mania, adopting a rational investment approach, diversifying their portfolios, and seeking sound market regulations to protect their investments. Thank you for watching this video on Tulip Mania. If you found this content interesting, please like and subscribe to our channel. If you have any thoughts or questions, feel free to comment below. Until next time.